Okay, let's jump right into this explainer. If you think back to 2025, it really felt like the entire global economy was playing a massive game of financial chicken. And now? Well, stepping into 2026, the confusion hasn't cleared up at all. If anything, it's amplified. We're getting these totally chaotic financial signals, leaving everyone wondering, are we on the verge of a historic, face-melting rally? A devastating crash? Or something else entirely? Today, we are breaking down the 3 potential market outcomes for the year ahead.
To cut through all that daily market noise, we're going to structure our analysis around 5 quick beats to give you a clear map of what to expect. First, the 2026 market setup. Then, Outcome 1, the bear case. Outcome 2, the bull case. Outcome 3, the choppy middle. And finally, surviving the unknown. Let's get into it.
All right, part 1, the 2026 market setup, or as I like to call it, a giant game of financial chicken.
So what exactly is happening in 2026? Look, last year was just a relentless tug of war between bears screaming about a recession and bulls buying up literally every AI stock they could find. Now, we are loaded with conflicting data. We keep hearing a million different buzzwords: soft landing, hard landing, no landing at all. It's the kind of setup where we could witness explosive market growth, or, you might look back in 12 months and think, man, I should have just bought safe government treasuries and completely logged out of my brokerage account.
It perfectly brings to mind that famous quote from John Maynard Keynes: markets can remain irrational longer than you can remain solvent. It's absolutely crucial to remember right now. Even if you spot deep fundamental flaws in the economy, betting against an irrational market can completely wipe you out before reality ever sets in. Being right too early, it's basically indistinguishable from being wrong.
Which brings us to part 2. Outcome 1, the bear case. Basically, the market finally pumping the brakes.
To really understand the bear case, we've got to talk about the elephant in the room: valuations. The S&P 500 is trading at nearly 31 times earnings. 31! To put that in perspective, the long-term historical average is just 16. That means across the board, stocks are incredibly expensive compared to the actual real-world profits those companies are generating. If these multiples simply normalize and revert back to historical averages, the entire market takes a massive hit.
And it gets even wilder when we look at the AI story. We might have gotten just a little ahead of ourselves. Look at these sky-high trading multiples. Investors aren't being for fundamental reality here, they're pre-ordering hope. You've got Nvidia trading around 47 times earnings, Palantir's sitting near 400 times earnings, and Datadog over 430 times earnings. At these levels, people are paying massive premiums for a perfect, flawless future that hasn't even happened yet.
So what's the result? The market has become incredibly top-heavy. It's kind of like a group project in school, where a handful of kids do all the work, but the whole group gets an A. Just 7 tech giants, the Magnificent Seven, make up roughly 35% of the entire S&P 500's market cap. This index, which is supposed to represent broad, safe diversification across the entire US economy, has quietly morphed into a highly concentrated bet on just a few tech heavyweights.
And the explosion in passive investing? It just pours gasoline on the fire. Because index funds are market cap weighted, every new dollar invested disproportionately flows straight to the biggest names, making them even bigger. It's a beautiful feedback loop until it reverses. A 10% drop in a giant like Nvidia doesn't just stay isolated to tech. It bleeds into the NASDAQ, it drags down the S&P 500, and suddenly your perfectly diversified portfolio is plummeting just because a few stocks woke up on the wrong side of the bed.
Statistically speaking, history tells us a cooldown is simply overdue. It's a concept called reversion to the mean. Basically, since 1954, the market has averaged a 10% pullback about once every 3 years. Corrections aren't these strange, scary anomalies. They are completely normal, healthy mechanisms to pump the brakes on overextended rallies. From a purely historical standpoint, a pullback is just waiting in the wings.
Okay, but what if the market ignores the history books? Let's look at part 3, outcome 2, the bull case, where the party just keeps on going.
So what if the market literally just doesn't care that valuations are stretched? While the bears are hyper-focused on the numbers inside the stock market, the bulls are looking out the window at massive fundamental tailwinds, specifically from the Federal Reserve and the US government.
It creates this incredibly powerful cause and effect chain. We're coming off consecutive rate cuts at the end of 2025, meaning capital is cheaper. And when capital is cheap, investors are way more comfortable paying premium prices for future earnings.
This loosening of financial conditions breathes life straight into risk-on assets, driving prices up even if the underlying economic data feels a little, well, confusing. Then you add in this absolutely staggering number, over $1 trillion. That is the sheer scale of the United States' annual deficit spending. Now sure, running on a massive deficit poses some serious long-term structural risks, no doubt about it. But the reality is that in the short term, this absolute ocean of cash acts as a colossal fiscal tailwind. Ultimately, this slow-to-change government spending provides a massive safety net for the economy, completely regardless of the fundamental risks. Unlike monetary policy, which can pivot on a dime, government budgets don't just disappear overnight. This constant injection puts money directly into the system, supports consumer demand, and props up corporate revenues. So even if natural economic growth cools down, this massive fiscal backdrop keeps the whole engine running hot.
All right, let's move on to part 4, outcome 3, the choppy middle, or as I call it, the uncomfortable gray area.
This is the scenario almost nobody is talking about, but it's highly, highly likely. What happens when the unstoppable force of government spending collides head-on with the structural risks of a completely overvalued market? You get a nasty tug of war. It's not a melt-up and it's not a crash. It's a market stuck somewhere in the uncomfortable middle. Headlines flip from doom to boom every 2 weeks, and rallies just stall out the exact second you start feeling confident again.
It's an eerie, frustrating environment. Capital just spins its wheels, rotating between asset classes. Every decision you make feels wrong, and impatience absolutely destroys portfolios. This long, choppy, sideways action is arguably the hardest market to survive. The dips feel terrifying, but they never actually drop low enough to give you a real screaming buying opportunity. It's just a total psychological grinder.
Which leads us to our final section, Part 5, Surviving the Unknown and Choosing Your Path.
With these 3 wildly different paths laid out, here is the ultimate takeaway for navigating 2026. Nobody, and I mean nobody, actually knows what's going to happen next. Whether the AI bubble pops, rate cuts fuel a never-ending rally, or we get stuck in that brutal sideways grind, you need a strategy to survive. If someone tells you they have a crystal ball, they're lying, trying to sell you something, or both. The best thing you can do is impartially absorb the data, recognize the mechanics at play, like index weightings and fiscal deficits, and form your own rational conclusions so you aren't blindsided.
So, what's it going to be? Are we breaking, rallying, or going painfully sideways? Which of the 3 outcomes are you betting on for 2026? Take a hard look at your own portfolio right now and ask yourself, are you positioned purely on hope, purely on fear, or are you truly ready for whatever the data throws at us next? Let's leave it there for you to think about.